Hello traders and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct for Dukascopy TV. My apologies for the absence. I have been touring Asia, but I'm back in the heart of the APAC region to bring you all of the exclusive interviews with Sydney's financial insiders. Coming up today, we speak to friend to Dukascopy TV, Julius Garofali of Stockbroking, to get the very latest on all of the ETFs that he's been looking at. Julius Garofali, always a pleasure to catch up with you. Thank you so much for seeing us today.
Thank you.
Okay, so we're talking Australian ETFs. Walk us through firstly the sector at present, really as you see it.
Okay, Natalie. Well, exchange-traded funds, ETF abbreviation, they're actually growing in our country at 60% per annum. Now, according to ASX data, about 100 ETFs have a market cap value of about $18 billion. Now, the last month's value of trading in ETFs in our market actually hit an all-time record high of $1.9 billion. And you're finding that a lot of the funds flowing are going into exchange-traded funds with international equity exposure. So it's quite a fast and maturing industry, and it's actually the way forward that we see it in investing markets.
Why then are retiree investors looking to ETFs then as more of an income-focused portfolio?
Well, the search for yield without attracting higher risks is becoming more and more difficult to find, and this challenge has been felt greatly amongst the retiree and self-managed superannuation fund industry. What you're finding that in such a low interest rate environment, ETFs actually showing quite a compelling return on comparison. There's such a nice range of high-yielding ETFs yielding from anywhere from 5% up to 11%, and they're paying dividends quarterly and even monthly, which is a lot more compelling than the dividends you're getting every 6 months from shares alone. I think one of the best things about ETFs and why superannuation and retirees like it so much is they're low cost, they're transparent, and they actually give you a good access to a diversified range of investments just via a single investment in that one ETF. I think the real punch on ETFs in general in this country is that it's provided the retirees with access to international markets, and that's been a very strong focus of late with interest rates being cut and our dollar falling. So before, to get access to these international markets, either you're awake at night, you've got to buy these stocks directly through offshore brokers. It's just been too messy, too much of a headache. You've got currency risk. No, it's much cleaner, efficient, clearer, cheaper, and transparent.
All good? What's the ETF then that you're receiving the most demand for?
Well, that, Natalie, would be hands down the Australian Dividend Harvester Fund, the fund manager being Beta Shares. It's a new retail offering, first that I've seen, and thus made it really attractive. The Harvester Fund came onto the market under the code HVST November last year. And the types of features that it offers is, one, it yields annually at approximately 11%. They pay monthly, almost 1%. There's a great deal of franking, tax-effective credits there. And also they provide a hedging situation in the fund where if the markets get out of control, they actually apply a handbrake and limits the downside risk. I think what you're finding with the Dividend Harvester Fund and the advice that we're giving clients here at Shores is that I would like, in general, a lot of clients to have a good percentage of this ETF in their portfolios, because what it's doing is it's actually elevating the yield across the whole portfolio and regulating dividend payments. And that's something exactly what the client's looking for in this market.
What are the benefits then of the HVST ETF from a client perspective?
Well, plenty. Well, firstly, it pays regular dividend payments, which is approximately 1% per month. And now most portfolios, you're finding that you're getting very little or if none or no dividends 4 to 5 months of the year. And a lot of my clients jokingly say that I'm on baked beans and toast for those months of the year. When the Australian Dividend Harvester Fund actually satisfies that by paying approximately 22 cents every month it's approximately the first or second of every month. One of the better features I find that the Australian Dividend Harvester Fund offers is their ability to limit the downside risk in the market. So if the volatility level of the market were to go anywhere higher than 12% as a reading, what the Harvester Fund does is apply a handbrake. And in general, rule of thumb, they say that the fund will fall 1/3 of the market, but it will go up 2/3 with the market. So as a general rule of the ETF, they run half the volatility of the S&P ASX 50, which is about 8.5%, and I think the current volatility of the ASX 50 is about 16.5%, 17%. So it just demonstrates a much smoother ride for the conservative investor, and this is just exactly what our clients are looking for in investing, and it suits them perfectly. One of the good things I like about the Australian Dividend Harvester Fund is the compounding effect. And this is the real trick. And a lot of clients, investors in general, they know about compounding. You get it from the bank, interest, earning on interest. Well, you can do the same thing with the Dividend Harvester Fund, and that's by reinvesting that 22 cents you're getting on the first or second of every month back into the fund. And you're finding that when you work out the interest rate on the compounding effect, it's not 11% per year. It's actually closer to 16.5% per year. With franking credits, it becomes closer to 22% per year, which is fantastic for the self-managed superannuation fund investors or retirees. So for example, if you've got $100,000, you're going to be making 16.5 grand a year, or a grossed up dividend yield of around that 22 grand a year, which is quite compelling. And that's, as I said, that's exactly what our clients are looking for.
What other ETFs then do you consider when looking at this sort of client base then?
Well, coincidentally, there's two really good ETFs that I like, and a lot of clients have had a real warm reception to, run by the same fund manager called Beta Shares. One of them is called YMAX abbreviation, and that's the Beta Shares ASX Top 20 Yield Maximizer Fund. Now, what that does, the fund offers a yield of around 8% or a grossed up yield of 9%, pays quarterly dividends, which again is better than just holding shares, which pay half yearly. And what the fund does, they buy strictly within the top 20 stocks, blue chips, and they sell call options against it. Now, a lot of clients get confused or rattled by derivatives in general. Well, you look no further. This fund does it all, and it does it cheaply. And by selling call options, they actually get a little bit better in the yield by getting option premium from the market. Now, that in turn does reduce volatility. So this particular fund, although high yielding and you get paid quarterly, it actually doesn't move as volatile with the market because they're getting that extra income from selling a call option. So what you're finding that when you're paying for a stock like Commonwealth Bank within the fund, they're selling a call option at a higher strike price. So across the fund, you're going to find that it will do great in sideways moving markets. It'll do fantastic in downward running markets. Slightly upward running markets will do okay, but really bullish markets, it will underperform. But let's face it, markets aren't going to run strongly forever, and this is a really good alternative, and it's really neat to have a little bit of this in the fund. One more other ETF that I really like, exactly the same fund, but in the United States, and that's called UMAX, that's the abbreviation. Yield Maximizer Fund, S&P 500, fantastic access to US markets. Again, why buy it directly? When you're asleep, they're awake, you've got that risk. Now, this fund buys within the S&P 500, again, sells call options against it. Yields 6%, payable quarterly. I struggle to find anything with yields in the United States of 2 or even 3%, yet I'm getting 6% from this fund. So they're both very similar. One is Australia and one is America. And I'd like to just say that in general, I think the real key benefits of ETFs is that they hold a basket of shares, which means that you don't have that single stock risk or the risk of single stock downgrade. Like, for example, the past reporting season, we had 2 to 5 downgrades in stocks. So a top 50 shares can't be downgraded in one hit. So that overall reduces the risks for the client. They don't want to see 2008 happen again. It's all about sleeping well at night, and that's just something that our clients are looking for that satisfies a lot of their concerns.
Julius, always great to catch up with you. Thank you for giving us your insight into ETFs. Much appreciated.
You're welcome.
Still to come this week on Sydney Direct, I'll be speaking to Director of Public Policy at the AI Group, Peter Byrne, to get his take on that RBA rate meeting.